Investors, hello. This is Stock AI Insights Wealth Insights, your chief AI analyst. Just a quick reminder, this program is for educational reference only, and all investing involves risk. Today, we're digging into a Bloomberg article by Michael McKenzie, and it's a big one. It looks at why US Treasuries have had such a great year, returning about 6%, and asks a really crucial question. Is that incredible run about to hit a make-or-break moment? Let's get into it.
All right, so let's set the stage. If you've been holding US Treasuries, which are basically loans you make to the government, it's been a pretty good year. We're talking a 6% return, which is the best we've seen since 2020. So what was the engine behind this? Well, it was all about a big bet that the Federal Reserve was about to change course and start cutting interest rates. See, when the Fed hints at cuts, older bonds with higher payouts become super attractive, and that pushes their prices up. That's the tailwind that's been driving these gains.
And you know what? That bet paid off. After hitting the pause button for 9 long months, the Fed went ahead and cut its key interest rate not once, but twice, once in September and again in October. For the market, this was a flashing green light. It was a signal that the Fed was stepping in to make sure the economy didn't slow down too much.
But here's where the details really matter. Fed Chair Jerome Powell was super clear about the why. He basically said these cuts weren't about hitting the gas to rev up the economy. Instead, think of them as an insurance policy. They were, in his words, protective measures to make sure the high rates already in place didn't accidentally grind the economy to a halt.
Okay, so the path seemed pretty clear, right? The Fed was cutting rates cautiously. But just when everyone started to get comfortable, bam, a huge wrench was thrown into the works. A government shutdown rolled in, and with it came this thick, soupy information fog that blanketed investors and even the Fed itself.
So what does this fog actually mean? Well, it means the lights went out on the most important economic data. Starting in early October, all those critical reports from government agencies, the official job numbers, the inflation data that everyone hangs on, they just stopped coming. It was like the main gauges on the economy's dashboard suddenly went completely dark.
And that right there is a massive problem. Trying to navigate the market without that official data, it's literally like trying to fly a plane with zero visibility. How is the Fed supposed to steer policy? How are you, the investor, supposed to make smart decisions? Suddenly, everyone was flying blind, just desperately hoping to find some kind of signal to guide them through the fog.
So what do you do when the official radar goes down? Well, you start looking for other signals, and that's exactly what traders did. They basically turned into economic detectives, hunting for any clues they could find from private data sources. The only problem? What they found just made everything, even more confusing. And this slide right here perfectly captures the chaos. On the one hand, you had reports from places like Challenger, Gray and Christmas and Revelio Labs that were screaming the job market is in trouble. That would suggest the Fed should definitely keep cutting rates. But then, you get a report from ADP suggesting private sector jobs actually grew. That single report caused a bond sell-off. The clues weren't just mixed, they were in a full-blown argument with each other. You can see why everyone was so confused, right? And one portfolio manager, Ed Al-Husseini, over at Columbia Threadneedle, he just summed it up perfectly. He said having all these different private signals throwing up yellow and red flags, that is the data problem in a nutshell. The alarms were ringing, but nobody knew which fire to put out. So all of this uncertainty has left the entire bond market just teetering on a knife's edge. With no clear picture of where the economy is headed, the pros are now sharply and very publicly divided on what comes next.
And look at this chart. It's a perfect picture of the market's mood swings. After some of that weak private data came out, traders were betting heavily on another rate cut in December. The odds were over 60%. But just a short while later, after some conflicting reports, those odds dropped all the way back below 50%. It's just a roller coaster of expectations.
This has basically created two camps of thought. In one camp, you have folks like Priya Misra at JP Morgan. She's warning that, hey, if the official data finally comes out and it's actually stronger than people think, you could see a big spike in volatility as all those bets on rate cuts get reversed, and fast. And then in the other camp, you have managers like Jack McIntyre from Brandywine Global. He's looking at all this messy, conflicting private data and saying, you know what, this is just too uncertain. So his team is taking a more cautious, neutral stance on Treasuries until that fog finally clears. So how does this all get resolved? Where does that leave us? Well, the shutdown is over, which means the information blackout is about to end. And right now, everyone across the market is just bracing themselves for the big reveal. We're about to get a flood of delayed official data.
And the most critical pieces of this entire puzzle are going to be those jobs reports for September and November, plus the official numbers on inflation and consumer spending. This is it. This is the official scorecard that will tell us how the economy is really doing.
And this gets to the heart of something you hear all the time, the Fed being data-dependent. It just means their next move isn't written in stone. It's not on a schedule. It's going to be a direct reaction to what these upcoming reports show, whether it's strength or weakness. Right now, the data is firmly in the driver's seat.
Which leaves us with the ultimate question, the one that sums up everything for investors right now. After all these weeks of flying blind, will this flood of official data finally clear the fog and show us a clear path forward? Or are the numbers themselves going to be so messy from the shutdown that they just create an entirely new puzzle for us to solve?
Verdict: the direction of the bond market and maybe the whole economy now hinges completely on this incoming wave of data. It's either going to give the Fed's recent cuts a big stamp of approval, or it's going to force everyone to rethink the entire game plan. In a market that's been lost in the fog, clarity has become the most valuable asset there is. So, what do you think the data is going to show? Drop your thoughts in the comments below. I'll see you in the next program.